Welcome to this explainer. For a lot of us, buying a primary residence is literally the biggest financial transaction we're ever going to make. But it's crazy how even seasoned buyers will sign these massive stacks of paperwork without fully grasping the hidden mechanics of the loan they're actually taking on. Today, we aren't just talking about how to get the keys. We're going to break down exactly how mortgages work under the hood so you can protect your wallet.
Now, let's get right into it. A mortgage isn't just a mountain of debt, right? It's actually a highly calculated financial tool of leverage where the home itself acts as collateral. Look, most people don't have hundreds of thousands of dollars in cash just sitting around to buy a house outright. So you make an agreement with a bank. You use their money to acquire a massive asset, and they grant you the loan on a very specific repayment schedule. But make no mistake, the bank isn't doing you a favor here. You aren't the collateral, the house is. If you stop making payments, they won't throw you in jail, but they absolutely will seize the asset. Acknowledging that this is a strict leverage agreement is your absolute vital first step to mastering your real estate goals.
So here's our roadmap for today. First, the anatomy of a mortgage payment. Second, choosing your loan type. Third, understanding rates and amortization. And finally, the 10 steps to closing day.
All right, kicking things off with Section 1, the anatomy of a mortgage payment, where we break down that monthly bill.
Okay, so every single mortgage payment basically sits on four main pillars, affectionately known in the industry as PITI. That's principal, interest, taxes, and insurance. If you invest in real estate, you probably know these four letters intimately. Principal is simply the actual money you owe the bank for lending you to cash. Interest is the fee you're paying them for the privilege of borrowing that money. And remember, the higher your risk as a borrower, the higher the rate the bank needs to compensate themselves. Then you have taxes, which fund your local schools and infrastructure. And finally, property insurance, which protects your asset from disasters like, falling trees or fires.
When you actually look at how that monthly check gets sliced up, it's pretty interesting. The taxes and insurance portions, those are usually grabbed by your servicer and stashed away in a special escrow savings account. Think of this escrow as a kind of forced savings account attached directly to your mortgage. Every single month, 1/12 of your annual property tax bill and 1/12 of your insurance bill get taken from your payment and parked right here. That way, when those big bills come due, usually once or twice a year, your mortgage servicer just automatically pays the municipality and the insurance company on your behalf.
Now here's the kicker. If you're putting down less than 20%, you're almost certainly going to get hit with PMI, or private mortgage insurance. This protects the bank's risk, but it does absolutely nothing to build your personal equity. Basically, private mortgage insurance gives the lender some breathing room if you default. It allows the bank to package your property into a security and sell it to bigger banks with way less risk. But remember, as the borrower, you're the one paying this monthly premium. It's really just the cost of entry if you don't have that heavy 20% cash up front.
Moving right along to Section 2, choosing your loan type. Basically, navigating the mortgage menu.
Standard conforming loans generally split into your conventional options and government-backed ones like FHA, VA, or USDA. An FHA loan is a total game changer if you've got lower credit or less cash on hand, letting you get in for just 3.5% down. If you're a veteran, the VA loan is just an incredible benefit. We're talking 0% down with absolutely zero PMI, which leaves you with way more cash out of pocket to invest elsewhere. And the USDA loan, which is backed by the Department of Agriculture, also allows zero down, assuming you meet certain income limits and are buying in an approved, typically more rural area.
When we step into non-conforming territory, it's super important to compare standard jumbo qualified mortgages, or QM loans, against true non-QM options designed for pretty unique scenarios. Non-QM has become a massive buzzword lately. People often assume that just because they have a huge jumbo loan amount, it's automatically non-QM. Actually, scratch that. That's not always true. A jumbo loan can still be a qualified mortgage meeting strict ability to repay standards. A true non-QM loan is for out-of-the-box situations. Maybe your debt-to-income ratio is over 43%. Maybe you're self-employed and need to qualify using bank statements instead of standard tax returns. Or maybe you have some recent credit challenges like a short sale.
All right, Section 3. This is where it gets really juicy. Understanding rates and amortization, or as I like to call it, the hidden math.
Listen, when you're shopping around and comparing lenders, you've got to remember that the interest rate is just the base cost of borrowing the money. But the APR, that reflects the true overall cost of getting that loan. You might see a lender advertising a fantastically low interest rate, but then you notice their APR is significantly higher. Why is that? Well, because they might be charging you heavy discount points or hefty origination fees up front to buy down that rate. The APR effectively bakes those upfront fees into the overall cost over time. So, if you want a true, honest, apples-to-apples comparison between two lenders, don't just stare at the rate, look at the APR.
To really show you the raw power of these terms, let's look at some math.
Say you finance a $280,000 loan at 2.89% over a standard 30 years. You are going to pay this massive number right here in interest alone. That is $139,000 going straight into the bank's pocket. You borrow $280,000, but your total cash outlay over 3 decades becomes a staggering $419,000. Just let that sink in for a second. When you just pay the minimum amount on a standard 30-year term, the math works heavily in favor of the lender.
But check this out. By simply cutting your term in half to 15 years, you save a staggering $74,000 in interest. Moving to a 15-year term drops your total interest paid to around $65,000. Now, yes, obviously your monthly payment is going to be higher, eating up a larger chunk of your current income, but you are paying far more towards your principal literally from day one. Which brings us to a very important concept.
And this is the reality. Amortization schedules are heavily front-loaded. That means for the first 6 years of a 30-year loan, you are basically handing the bank more money for interest than you are putting into your actual home equity. So if your monthly payment is roughly $1,100, you might find that only about $480 of that is actually knocking down your debt in those first few years. The rest, pure profit for the bank. It usually isn't until around year 6 or so on a 30-year fixed rate that your principal payments finally cross over and exceed your interest payments. That is just the stark reality of amortization. Okay, let's bring it all together in Section 4, the 10 steps to closing day, the real-world timeline.
Before we start the clock on the timeline, let's meet your cast of characters. Your loan officer is the person you'll be talking to the most. They are your guide through the wilderness. The processor takes your file and basically double-checks all your documents. But the underwriter, they're the real gatekeeper. They assess the financial risk, and honestly, they're the only person standing between you and your new front door. And finally, the closing agent, who gets you across the finish line when it's time to sign on the dotted line.
So the actual process kicks off with a literal mountain of initial disclosure paperwork. Seriously, stretch out your signing hand because it's a lot. Then the lender preps your file. Step 3 is vital, the appraisal. The bank absolutely needs a professional to confirm the home is actually worth what you're paying for it. Once that comes back clear, you get your initial loan approval and you receive the closing disclosure, which is the final document outlining all your finalized terms and exact costs. From there, we are basically sprinting to the finish line. The underwriter reviews everything one last time. Once you get that magical cleared to close, you coordinate your expectations, set an appointment with the closing agent, and sign the final massive stack of documents. In Step 10, the lender officially transfers the money, and congratulations, you finally get the keys and take ownership of the property. Now, I want to share a golden rule of affordability. Your all-in housing budget really should be based on your take-home pay, not your gross salary. So many people get themselves into serious financial trouble because they calculate what they can afford using their gross income. You know, the big number before taxes, insurance, and retirement contributions are stripped out. You need to look at what actually hits your bank account. And remember, that 30% rule isn't just for the mortgage itself. That includes your property taxes, your homeowner's insurance, any HOA fees, and utilities. If you lock up 50% of your net income in a house, you become what we call house poor. So I want to leave you with this thought to really challenge how you look at your financial readiness for what's probably the biggest and potentially most rewarding transaction of your life. Are you truly prepared for the all-in costs, or are you just looking at the bank's quoted principal and interest? By understanding PITI, the front-loaded nature of amortization, and the crucial differences between an interest rate and an APR, you are now armed with the actual building blocks to make a highly educated decision. Thanks so much for joining me for this explainer, and I will catch you on the next one.